Collier family, Happy New Year and welcome to our 2023 Outlook video. Today we want to talk about what happened in 2022, we want to talk about what we have an eye on in 2023, how that relates to both the stock and bond market for this upcoming year, and then we're going to introduce a new section called Devil's Advocate, or the other side of the trade, with Will McMannis. With that being said, let's talk about what happened in 2022. There's no getting around it. 2022 was a volatile year. The overall US stock market was down almost 20%. But that doesn't tell the whole story. The more speculative tech names and even some of the larger tech names that we all know and love were down over 33% for the year. The most interesting thing about 2022 was the bond markets were down. The bond markets were down about 13%, which marks the worst year on record for bond markets. The second worst year was 1994, when the bond markets were down only 3%. So pretty big difference between the two worst years for the bond market. The main culprit in all this was inflation and the necessary actions by the Federal Reserve to combat inflation. The Federal Reserve rose interest rates from 0.25 to 4.5% in a single year, which is rather unprecedented in history and caused a lot of the volatility. So how much of this continues into 2023? What do we have our eye on? Let's explore that. The consensus estimate is that inflation continues to trend down for 2023. The Federal Reserve has been clear in their communication that they are coming to the end of their interest rate hiking cycle. So we turn our attention to corporate earnings and jobs. Corporate earnings trended down every quarter of 2022. If that continues in 2023, we believe that eventually has an effect on the job market. Now, the first job numbers we've gotten for the year, the labor market is strong right now. But we're watching closely the effect of declining corporate earnings on the job market and what that means for the overall economy. We believe the market's waiting for further clarity on these points before it finds its path forward. With that being said, let's talk about our outlook for the stock market this year. We expect volatility to continue in 2023 while the market waits on clarity on, are we going into a recession or not? Will the Federal Reserve actually be able to stop their interest rate hiking campaign? So what can we do while we wait? Well, the first thing we can do is we can focus on rational investing, a return to fundamentals, if you will. This is what worked in 2022, investing in companies that have strong and predictable cash revenue. The second thing we can be focusing on is making sure that you are getting paid while you wait. How we do that is we focus on companies that pay strong and consistent dividends. These are the areas we're focusing on while we're waiting on economic clarity throughout this year. Now, let's introduce the new section where Will hops in here with the Devil's Advocate. How could this trade go the other way? With that, Will McMannis.
Hey Collier family, Will McMannis here with the Devil's Advocate. Now, the Devil's Advocate is something Brandon and I do here in office where no matter how rational or how much we agree with what the other person is saying, we force the opposite party to take the other end of the trade, right? To say the opposite. Now, I'll predicate this with I wholeheartedly agree with Brandon that the return to rational investing is what needs to occur in 2023. But the other end of the trade is the market doesn't have to be irrational. It's been irrational for years, right? Look at what's occurred between Peloton and Procter & Gamble. The stock performance between the two, right? Procter & Gamble makes a lot more money than Peloton, but Peloton's stock performance for the longest time was outperforming it, right? Look at what happened with the crypto craze or the online meme stock Reddit craze, or think about housing. Housing alone, there was a period of time in the last couple of years where people were offering 20% above asking price, no inspection, sight unseen, right? Not the most rational way to purchase an asset. Nothing says that the market has to remain rational. Right? If we look at what could occur in 2023, and if the market decides to favor irrational investing again, that's something that we're not going to participate in.
Now let's talk about everybody's favorite investment, bonds. The underperformance in 2022 was due to the Fed's unprecedented interest rate hiking campaign, which they have since communicated they intend to stop this year. Now, there's a bit of game of chicken going on between what the Fed is saying and what the bond market is pricing in. My dad taught me long ago, never fight the Fed. So we take the Fed at their word that they will stop raising interest rates in 2023. How that affects our bond investments is we believe much of the interest rate volatility that happened in 2022 is done. And what this has created is an opportunity where we can get paid a very good interest rate on what are deemed safe bonds at this point. You can earn over 4% on a 1-year United States Treasury bond right now. We haven't seen that in 20 years. So this provides an interesting aspect for the portfolios going forward. Again, with the theme being paid while we wait, we have an alternative to stocks now that pay us a decent interest rate with bonds. So we are rather optimistic for that for the upcoming year. So again, Will coming through with the devil's advocate point of view here.
Hey guys, welcome back to another Devil's Advocate, where no matter how much I disagree with what I'm about to say, I have to say it anyways. And Brandon's right. There is a game of chicken going on right now between the bond market and the Federal Reserve. Federal Reserve, they're not infallible, right? They've told us they were going to do something and not followed through before. 2018, they said they were going to raise interest rates and they turned around and cut them, right? So they've told us right now they're going to raise interest rates a couple more times and they're going to maintain them for the rest of the year. I've been lied to before. If they cut interest rates, right, that changes the dynamics for the fixed income market. That changes the dynamics for the bond market. And in that environment, I'd much rather own stocks than own bonds, right? Because we're talking about an environment where money gets cheaper. Interest rates go down. That's stimulating growth in the economy. Fixed income isn't where you go to purchase growth. You go to stocks for that.
There you have it, Collier family, our 2023 outlook. We expect volatility to continue this year. We're monitoring closely the things that are moving the markets. And when it comes to your money, we have a return to rational investing, focusing on the fundamentals of the companies that we're invested in. And we have a strategy to make sure that you are getting paid while we wait for clarity. Now, I think it's important to pause here and remind you that it is our job to be available to you how and when you guys need. So if you see, hear, read something that you want to talk over with the team, please don't hesitate to pick up the phone. That's what we are here for. With that, Happy New Year. We look forward to seeing you throughout the year.